hunter-gatherer societies participated primarily in gift economies. Hunters would bring home meat, while gatherers would forage for fruits, seeds, nuts, and vegetation. People didn't really trade, but instead they would give their bounties as gifts. If a certain hunter-gatherer is having an unlucky day, then instead of allowing that individual to starve, another member of the tribe would offer them food, and at some point later, the first hunter-gatherer would pay him or her back. Gift economies are based on the relationships between the people, rather than the relationships between the items being exchanged. Gift economies still exist today in the world of open source software projects, religious tithings, and in the way that middle-aged generations are implicitly expected to care for the younger and older generations. But because gift economies rely very strongly on relationships, they really only made sense in small tribes. As the human population expanded and economies got more complicated, gift economies became impractical. Societies eventually started moving towards barter economies. Bartering is a system of exchange, where people exchange goods and services directly without the use of a common medium such as money or gold. The earliest forms of barter recorded date back to ancient Mesopotamia in 6000 BC. In a bartering system, a woodchopper would trade their wood directly for the items that they needed. So say the woodchopper wanted wheat, but the farmer selling the wheat might not want wood, and maybe they want sandals instead. So the woodchopper would have to find someone selling sandals that also wants wood, and only then can you trade your wood for sandals, and then your sandals for wheat. Obviously, this became incredibly time consuming, and when people can't trade for what they need, then they end up having to steal it instead. To address the problems that started to emerge as part of barter systems, people started to adopt commodity money. Commodity money is where a commodity is used as a medium of exchange. Examples of commodities used as money include gold, silver, copper, salt, peppercorn, tea, shells, cigarettes, and barley. Canadians used to use beaver pelts, and Australians were known for using rum. Commodity money greatly simplified trade, because people agreed to accept a standard commodity as payment, instead of bartering between all the possible items that people might want to trade. It also let people set prices, relative to the agreed upon commodity. The first recorded cases of commodity money occurred around 2600 BC in ancient Egypt. At the time, grain was being used as the main commodity. The first banks were used to store grain, and from there they would distribute wages to workers. But it wasn't long until gold was becoming a popular form of exchange. Gold, compared to grain, was much more durable, portable, and scarce. If a person wanted to pay for cattle, it was much easier to pay with a couple of ounces of gold rather than 20 sacks of grain. Eventually, the amount of gold in circulation became difficult to manage, and people needed to find trustworthy places to store it, so grain banks were replaced with gold banks. The idea of paper money like the US dollar would not appear for a long time because paper did not exist until 105 AD. The first banknotes appeared in China in the 600s, and they were simply receipts. When a person deposited gold into a bank, the bank would give the person a receipt. Since this receipt could be returned to the bank in exchange for gold, people started exchanging the receipts instead, almost as if they were gold. And this became the first instance of what is called representative money, where commodity money is the commodity itself. Representative money represents a claim to a commodity. The most popular form of representative money is the gold standard. This is where a nation's currency is linked to the price of gold. The US, for example, was on the gold standard for much of its history. And before the gold standard was suspended in 1971, the US dollar was fixed to gold at a rate of $35 per ounce. The next step in the evolution of money comes in the form of central banks. In 1690, Britain was in the midst of war against France, and the French Navy was decimating them. So a central bank, called the Bank of England, was formed as a way for the British government to raise funds for wartime efforts. The government would issue a bond to the central bank, which is basically a piece of paper saying that the government wanted a loan and that it would pay it back with interest. Then the central bank would take the bond and find lenders, which were usually private banks, businesses, and foreign investors. The lenders would give the central bank their gold, and in return, the central bank would issue the lenders paper money. The paper money could not be used to reclaim gold, because the country was at war, but it could be used instead to pay taxes back to the government at a later stage. So in summary, the government asks for loans by issuing bonds. People give the government gold in exchange for paper money. People trade using paper money, and eventually give the money back to the government when they pay taxes. So if you think about it, paper money is just a symbol of government debt. This is what you call fiat money, money that is based on government debt. Fiat is Latin for let it be, which basically means that fiat money is deemed as valuable because the government says it is. In 1775, Americans were going through the American Revolutionary War. They had a lot of trouble funding the war, so they printed some money called the Continental, which they used to buy guns, food, and other war things. Now, if the government prints too much money, then the money becomes less valuable, and prices of goods and services will go up. This is called inflation, and it's exactly what happened to the Continental. They printed it furiously, until 6 years later, the Continental was worth nothing. Not a good look for a newly formed government, so they tried to open up a central bank, like the one in England, but people were divided about it. The states believed that it gave the federal government too much power, and that the bank would be used to fund political agendas. Between 1782 and 1836, they tried 3 times to run a central bank, but all of them were eventually terminated. Then major problems started occurring, because the central bank was not just an institution for funding wars anymore. It became an institution for regulating and bailing out banks in order to stabilize the economy. So without the central bank, the nation underwent a series of devastating monetary crises from the mid to late 1800s. To understand why, we need to understand fractional reserve lending. The United States was on the gold standard for most of the 1700s and 1800s. Most people stored their gold in banks for safekeeping, and they only held a very small percentage of their money on hand. This meant that a very large percentage of wealth was just sitting around in vaults doing nothing. So people realized that for as long as a bank reserved enough money to allow their customers to make withdrawals, then they could lend the rest of the money out and charge interest on the loans. This sounds a little unethical, because you're essentially lending out other people's money. But it meant that entrepreneurs could more easily take out loans to start new businesses and create more goods, services, and jobs in order to spur a thriving economy. So this type of activity is actually encouraged by the government. So much so that laws were introduced so that when a person deposits money into a bank now, that money becomes the legal property of the bank and not the person. The problem is that sometimes a bank lends out too much paper money, and they don't have enough gold to honor the withdrawals of their customers. Then the bank has to try to get a loan from the other banks, but if the other banks don't trust them, then the bank goes bankrupt. If a bank goes bankrupt, then the savings of all of their customers get wiped away with it. People obviously don't want that, so when one bank falls, it sets off a chain reaction. People panic, they drain the reserves of perfectly healthy banks, leading to more bank closures and more panic. So the central bank would set reserve requirements for all relevant private and state-owned banks, and force them all to pool their reserves together and store them in the central bank. So when a bank is about to go bankrupt, the central bank could bail them out in order to prevent a crisis. The absence of central banks led to monetary panics in 1884, 1890, 1893, 1896, and 1907. 1907 was the last straw, and Senator Eldrick was tasked to draw up plans to set up a central bank which was eventually called the Federal Reserve, or the Fed for short. The Fed was established in 1913, and it's a very complicated beast, so we'll go through it in another video. But it's basically a network of 12 regional reserve banks that are individually run by local bankers, which all answer to a governing body of 6 people that are appointed by the President and approved by Congress. The Fed was formed primarily to act as a reserve for gold and government bonds. It had the power to set reserve requirements and interest rates. It was also given the power to create new dollars as a lender of last resort, but that power was limited by their need to back up those dollars to some extent with gold. So time went on, and in 1971, Nixon famously suspended the gold standard in order to fund the Vietnam War, create jobs, and stabilize exchange rates. The gold standard had been suspended before, For example, Lincoln suspended it in 1861 to fund the Civil War, and it was reinstated in 1879. But since 1971, the gold standard has never been reinstated. So we have remained on a fiat currency ever since. As we discussed before, fiat currencies are based on government debt, and they're only as valuable as a government's ability to manage debt. The seemingly permanent suspension of the gold standard also means that the Federal Reserve no longer needs to hold reserves of gold, and they don't even need to back up dollars with gold anymore. Earlier, we talked about the Bank of England, and we said that the government gives the bank a piece of paper called a bond asking for gold. Then the bank would go find lenders. The lenders would give the bank gold. The bank gives the lenders paper and gives the gold to the government. Before Nixon suspended the gold standard, the government would issue a bond. The Fed would look at the reserves it was given by all of the banks that registered with it, and it would give the government as much of those reserves as it was willing to risk. The Fed can't give too much, because the reserves are needed to stabilize the private banks in the case of a crisis. So when people say that the Fed is independent of the government, this is why. Because for most of history, the Fed could not lend out an infinite amount of money, and had to weigh up the risks. If they gave the government too many dollars, then there'd be more dollars in circulation that they need to back up with gold if there were a crisis. So this would be very dangerous for them. But since dollars aren't backed by gold anymore, when a bank is in trouble, then the Fed just signs something and the problem is fixed. They don't even have to print anything, because it's all digital. Someone just changes some numbers here and there, and the crisis is averted. And the same goes for when the government needs a loan. The Fed doesn't really do anything, they just sign a piece of paper and change some numbers on a computer. It might be a bit too easy. It took about 200 years for US national debt to reach 1 trillion. And since 1971, the debt has grown all the way to 28 trillion. Hey guys, thanks so much for watching. This is our very first animated video. We're a super new channel, so if you liked the video and want to see more stuff like this, then just make sure to like and subscribe, it really helps. Thanks guys.